So your buyer just bought a home and later that year they received a supplemental tax bill. So why did they get this? What is it? And for some people, why did they receive 2 supplemental tax bills instead of 1? So when you buy a home and your purchase price is higher than the purchase price of the prior owner or the assessed value of the prior owner, you will receive a supplemental tax bill. And in some instances, you might receive 2 instead of just 1. Supplemental tax bills cover the difference between your purchase price and the assessed value of the prior owner as of January 1st of that current year. So if you bought a property for, let's say, $700,000 and the prior owner purchased it for $500,000, your prorated supplemental tax bill is going to be based off the difference of $200,000. These supplemental tax bills are a one-time bill only for that current year, unless you do some sort of construction that changes your assessed value of your property. But going forward, after the first year, you will only receive 1 secured annual tax bill that's going to be based off your new assessed value. In California, the tax collector sends out their annual secured tax bills every September or October. But the supplemental tax bills are sent out separately, and usually they're sent out about 6 to 8 months after the purchase of the property. I often get asked by many of my clients, why did my buyer get 2 supplemental tax bills and not just 1? Well, the first thing you got to understand is that the tax collector and assessor go off their own fiscal tax year, and their fiscal tax year runs between July 1st and June 30th. So when you're trying to determine whether or not your client's going to receive 2 supplemental tax bills or 1, it's all going to be decided based on what time during that tax year they purchased their property. So the county establishes their assessed values on January 1st of that current year. So general rule of thumb to determine whether or not you're going to receive 1 or 2 supplemental tax bills. If you purchase that property between July 1st and December 31st, then most likely you'll just receive 1 supplemental tax bill. Let's assume that your buyers purchased the property on May 31st. Now their tax bill is going to cover 2 separate fiscal tax years, and they will probably receive 2 separate supplemental tax bills. They would receive a supplemental tax bill for the difference in value between April 1st and June 30th, and then a second bill for the period between July 1st and June 30th of the following year. Lastly, please note, if your property taxes are impounded, generally the lender does not cover or pay for supplemental taxes, so your buyers will be responsible to pay their supplemental tax bills even if their taxes are impounded. So if you have any other questions, I'm happy to help. Just give me a call. Have a great day.